Markets are eagerly anticipating further talks with China, but with a little indicator of a trade resolution and impeachment worries, can more volatility be on its way? Joining me today, Peter Hug, Global Trading Director of Kitco Metals. Pete, so good to see you. It's been way too long. Welcome back.
Thanks. It's nice to be here again.
All right. Well, I want to dive into it since we have a lot of topics to get through today. Let's start with President Donald Trump scheduled to meet the Chinese Vice Premier on Friday. What are some talking points we should be expecting? And how likely do you think a deal could be reached before the 2020 election, Pete?
I don't anticipate a deal in the context of a major coup from the perspective of what Trump wants. I think there's going to be a concessionary deal struck. At least I hope so. It's been going back and forth, but at least I hope there's a conciliatory deal struck where I think the Chinese may buy some additional ag products. The U.S. may not drop tariffs, but may delay implementing the increase that's due at, I believe, at the end of next week. Just so somebody can they both can walk away with somewhat saving face. I think Trump needs a win here, given the political storm he's involved with now with the Ukraine situation. He needs a win, and the stock market is sort of moving back and forth, and also needs at least the China squabble to quiet down, because I think the Fed is in the corner of the market, and I think the Fed over the next few rate meetings is going to posture themselves in an easing cycle. They've already indicated that they're with their repos that they're adding liquidity to the market. So I think the Fed is the backstop. But if China falls apart, then the stock market falls apart, and then all hell breaks loose again. And obviously, at that point, gold will shoot up considerably higher.
All right. Well, moving to the topic of impeachment, according to a recent Quenpac poll, 45% of Americans said Trump should be impeached. So far, markets aren't responding to this news. Are investors predicting no change in the status quo then, Pete? How do you see that?
I think the Democrats will follow through. They may have the impeachment hearings, but the trial, so to speak, is going to be in the Senate. And unless the evidence is extremely explicit and overwhelming, and the Republicans feel that their constituents will also support them, I don't think there's a snowball's chance in hell that he's going to get convicted in the Senate, and it's just going to go away. But it creates all that noise, and nobody's getting anything done in Washington, and I think that's what's also adding to some of the angst in the overall markets, and sort of supporting the metals, at least in the short term.
Pete, I know a lot of our viewers are anxious to get your thoughts on the gold price, since we haven't spoken in a while. You mentioned at the start that gold could move significantly higher, but a few scenarios would need to unfold. But right now, it seems the metal has hit a ceiling at the 1550 mark. Why is it struggling to retest the August highs here?
Well, you have to take it in context. When we, I can't remember now the last time when we spoke, but when we made the call that we were constructive gold, and just to be clear, I'm still constructive gold. We were looking at a number of factors. Brexit looked like a total mess. The Chinese trade deal was a total mess. The stock market was looking wobbly. The Fed was sort of engineering a more hawkish attitude when we spoke last, which I believe now is almost 6 weeks to 2 months ago. So in that interim, you had gold react appropriately to all of those outside influences. But some of those things have sort of, the edge has been taken off them. The Brexit deal looks like Britain will leave the EU, but it looks like they're going to leave the EU with the deal. The Irish Prime Minister today indicated that he was happy with the path going forward, and the Irish issue with the Brexit deal with Britain and the EU was a major concern. That looks like it may be somewhat resolved, or at least resolvable. You've got the Fed that continues to be on an easing path, but they're also they're also talking out of the sides of their mouth. They're indicating, well, if the economic data continues to be okay, we may not be aggressive on lowering rates. And then the next day they change their mind. So there's been sort of issues that have taken the edge off the gold market. And, profit taking after that run in gold, and obviously also in silver, when silver just took off and went to 1950, is totally logical. And we came out at the time and indicated that we thought the market was heavy and it was coming down. And after it broke down a couple of weeks back, when it was down in the low 80s, we suggested to be constructive again and buy gold on a close above at that level with an anticipated move up to 1520. And we got that move about 5 days ago. And again, if you're a trader, you've got to trade the chart levels. And at 1520, that's resistance. You've got to take the money off the table and then just watch the market. And right now, we're still watching the market.
Pete, I brought this up during the Denver gold coverage, and I asked a few people this, and I wanted to get your thoughts on it. Do you think sometimes there's just too much expectation placed on gold, that when it starts those rallies, we just want more and more and more? More than other metals, I feel.
Well, no, I believe that. I mean, there's a large contingent group of investors that believe that the market should be considerably higher than where it is. Right. And I mean, if you use the argument based on our global debt, they're right. I mean, gold should be higher than where it is at $1,500, and I think the day will come when gold will surpass the 2011 high. But when you get that type of movement and that type of volatility and momentum, corrections within that momentum surge are totally normal. Many investors indicate that correction is called manipulation, but I think it's just a normal market correction. And so I think the underlying factors that will keep the precious metals markets buoyant over the next year or two are still in place, but nothing goes in a straight line. And, if gold was running now and went to $2,500 or $3,000 in a straight line, there would be a serious issue somewhere. It could be a collapse in the stock market, could be a collapse in the bond market, could be a housing collapse, it could be a war. Right. It will take that type of event to create that straight line move up. And again, I'm not in the camp that wants that kind of a move. Mm-hmm. I think gold, from a perspective of a portfolio asset, makes total sense, and I wouldn't sell it at these levels. But if you're looking for gold to go to $3,000, $4,000 in a straight move, I think that day will come, but I don't think it's imminent.
Right, and you have to ask yourself, what world do you want to live in? What type of world?
Yeah, I made that comment a ways back, and people disregarded it. I'd prefer to have gold sort of move up on average 5-10% a year, but I'm really not looking forward to a gold world where the price of gold, or the world where gold is at $5,000 an ounce on a straight shot up, because I know there's going to be severe damage somewhere else.
All right, Peter Hug, thank you so much for those insights today.
Okay, you're welcome.
All right, we'll see you soon, and thank you for watching. We will have much more for you on Kitco.com. Stay tuned.